Welcome back to the deep dive. It is Wednesday, February 11th, 2026. And today we are looking at a stack of documents that feels less like a standard corporate report and more like I don't know, a victory lap.
It absolutely has that victory lap
Yeah,
feel.
yeah, but maybe with a few warning signs hidden in the margins. We are unpacking T-Mobile US Inc.'s fourth quarter and full year financial results for 2025.
It's a huge release, and you're spot on about the victory lap. When you read through this report, the phrase industry leading just appears so often it almost starts to, lose its meaning.
That was my first takeaway. It felt like I was reading marketing copy. I was drinking my coffee this morning, looking at the executive summary, and I just thought, okay, surely they can't be leading the industry in everything.
Right.
But I guess our mission here today is to strip that swagger away. We need to figure out if the numbers actually back up all this confidence, because looking at the headline, they are claiming some massive growth in a market that, let's be honest, feels completely saturated. I mean, who doesn't have a smartphone at this point? My toddler basically has a smartphone.
And that is the central mystery we need to solve today. You see, the U.S. wireless market is effectively a zero-sum game. If T-Mobile adds a customer, logically, they usually have to steal them from Verizon or AT&T.
Right.
And yet, T-Mobile is putting up growth numbers that, well, they shouldn't really be possible in such a mature market. They call it a winning formula based on widening differentiation.
Widening differentiation. That sounds a lot like MBA speak for we're leaving the other guys in the dust.
Essentially, yes.
So here's the roadmap for you listening. We're going to break this massive report into 4 specific areas so we don't get lost in the weeds. First, the customer avalanche. Where are all these millions of people coming from?
Right.
Second, the money. How does this popularity contest translate into, hard cash? Third, the network, and this is the big one. Have they finally killed that old bad coverage stereotype?
A very important one.
And fourth, the fine print. The layoffs, the acquisitions, and what happens next.
Sounds like a solid plan, and I think you have to start with the sheer volume of humanity that is joining T-Mobile's network.
Okay, let's do it. Section 1, the customer avalanche. I saw the top line number for Q4 2025, and I genuinely thought it was a typo. Total postpaid net customer additions, 2.4 million in just 3 months.
It's not a typo. And to give that some context, 2.4 million net adds in a single quarter is what we call industry best by a very wide margin. For the full year of 2025, they added 7.8 million postpaid customers.
7.8 million people. That is roughly the population of Hong Kong.
We're Washington State, yeah.
Added to their billing system in 12 months.
It's a staggering amount of volume.
But I want to pause here and maybe clarify some terminology because we hear postpaid and prepaid all the time in these telecom deep dives. Why does the report obsess over postpaid? Why is that the gold standard?
That's a great question. It's really about the quality of the revenue. So postpaid generally means customers who pass a credit check and pay a monthly bill at the end of the service cycle.
The traditional phone contract.
Exactly. And they're the most valuable because they're reliable, they usually stick around longer, and they often buy expensive devices on payment plans. Prepaid is more volatile. You pay up front, no contract, easy come, easy go.
Ah, okay. So when T-Mobile says they added 7.8 million postpaid customers, they're saying they added 7.8 million high-value, stable sources of revenue.
Right. These are not burner phones. These are long-term relationships.
That makes perfect sense. It's the difference between a subscription and just a one-off purchase. But let's dig into what these people are actually buying. Is this just 7.8 million new iPhones?
No, and this is where their strategy gets really interesting. The bread and butter is still phones. In Q4, they added 962,000 postpaid phones. For the full year, it was 3.3 million.
Which is still fantastic growth for the core business.
Oh, absolutely. But the other huge chunk of growth is coming from something that isn't a phone at all.
You're talking about the broadband numbers.
Exactly. High-speed internet. They added 558,000 net broadband customers in Q4 alone. And that brings them to 2.0 million new broadband subscribers for the year.
So this is that little gray box you put in your window, right? The fixed wireless access thing?
Yes. It uses their 5G network, the exact same signal your phone uses, to power your home Wi-Fi. And here's why this matters so much. T-Mobile has effectively become one of the largest ISPs, internet service providers, in the country.
Wow.
The report says they ended the quarter with 8.5 million 5G broadband customers.
That's 8.5 million households who probably just fired their cable company.
Precisely. And that's a massive disruption. For decades, cable companies had a geographic monopoly on high-speed home internet.
Oh, yeah. You moved into an apartment and you had one choice.
One choice. T-Mobile's coming in and saying, you don't need the wire anymore, just plug this in. It's unlocking a market they never had access to before.
It's brilliant because the infrastructure is already there. They built the tower for the phones, and now they're just selling the excess capacity to houses.
Right.
But here's the skeptical question I always have. Acquiring customers is one thing. Keeping them is another, especially with wireless home internet. I've heard people complain about speeds dropping during peak hours. Are people just signing up for the cheap deal and then canceling 3 months later?
Well, the data says no. This is the metric we call churn.
Churn.
It measures the percentage of customers who cancel their service every month. It is the silent killer of telecom companies.
Because you're just filling a leaky bucket.
You're just running on hamster wheel.
Yeah.
So how big is the leak at T-Mobile?
Yeah.
It's barely a drip. In Q4, postpaid phone churn was 1.02%.
2%. So basically only 1 out of every 100 customers leaves per month.
Correct. And for the full year, it was even lower at 0.93%. And the wireless industry hovering around or even below 1% is just incredible. It implies a fiercely loyal customer base.
It tells us that not only are people switching to T-Mobile, but they're finding the experience good enough to actually stay.
That's right.
And that really challenges the old reputation of T-Mobile being the churn and burn carrier. I remember back in the day, the joke was you signed up for T-Mobile to save money, but you kept your Verizon account just in case.
Laughs. That era is clearly over. They're winning on two fronts now. They're putting a phone in your hand, and they're replacing the cable guy.
A double whammy.
It is.
Okay, so we've established they have the volume, they have the people. Now let's move to section 2, the money. Because as the saying goes, revenue is vanity, profit is sanity.
Right. You can give away 5G for free and get 1 billion customers, but you'll go bankrupt in a month. The question is, are they translating this popularity into a sustainable business?
So did they make money on these 7.8 million new people?
They certainly did. Let's look at service revenues. This is the money they make from the actual monthly bills, not from selling the phones themselves, because, frankly, carriers don't make much profit on the hardware.
Right. The real money is in the service.
Exactly. In Q4, service revenue grew 10% year over year to $18.7 billion. For the full year, it was up 8% to $71.3 billion.
A 10% growth rate for a utility-style company is...
Yeah.
It's rare. Usually you see these telecom giants fighting for 1 or 2% growth.
Exactly. This is growth stock behavior in a utility sector. And investors love this because it's defensive. People pay their phone bills, even in a recession. But it's also growing like a tech company.
And it flows down to the bottom line.
It does. They reported core adjusted EBITDA of $8.4 billion in Q4. That's up 7%.
Okay, let's pause on core adjusted EBITDA. That is a mouthful of corporate jargon. How should we visualize that number?
Think of EBITDA, and that's earnings before interest, taxes, depreciation, and amortization.
Always a mouthful.
Always. Just think of it as a proxy for the company's operating cash flow. It's a measure of how good the core business is at generating profit from its operations, before you account for all the accounting tricks, tax bills, or paying off debt interest.
So it basically says, is the machine working?
That's it, exactly.
And at $8.4 billion for the quarter and nearly $34 billion for the year, the machine seems to be working just fine.
It's humming. But the number that investors really care about, the one that allows a company to control its own destiny, is free cash flow.
This is the walking around money.
Essentially, yes.
Bro.
Adjusted free cash flow is the cash left over after they've paid their operating expenses and paid for all the capital expenditures.
Like building new towers and upgrading the network.
Precisely. In Q4, that number was $4.2 billion. For the full year, $18.0 billion.
$18 billion in pure usable cash. That is a staggering amount of liquidity. What are they doing with it? Are they just sitting on a dragon's hoard of money?
No, they're giving it back to the people who own the company. The report highlights that in 2025, T-Mobile returned $14.0 billion to stockholders.
How do they do that?
Through dividends, which are direct payments, and share buybacks, which makes the remaining shares more valuable.
So if you held T-Mobile stock in 2025, you were essentially getting paid to wait.
A very good year to be a shareholder, yes.
Yeah.
And the report calls this financial growth durable.
Durable, that's an interesting word choice. It implies it's not a fluke.
It links right back to that churn number we talked about. If you have low churn, your revenue is predictable.
Ah, okay.
You know that next month, 99% of those people are going to pay their bill again. And that predictability allows them to forecast cash flow with very high accuracy. It's a flywheel,
More customers lead to more cash.
which leads to more network investment, which leads to more customers.
Okay, so the financials are rock solid, but I want to play devil's advocate for a second. For a long time, the trade-off with T-Mobile was clear. You pay less, but you lose signal when you drive into the countryside or walk into a thick building.
The Swiss cheese coverage map.
Exactly, the can you hear me now problem. So does that reputation still hold up? Or is this report hiding the ugly truth about their network quality? This brings us to Section 3, network supremacy.
This is arguably the most important part of the entire report
Yeah.
because it signals a fundamental shift in the U.S. wireless reality. The report cites the J.D. Power 2026 U.S. Wireless Network Quality Study.
J.D. Power is the big one. We see their awards in car commercials all the time. But here, they're surveying actual customers about their experience, dropped calls, slow data, that sort of thing.
Correct. And for years, I mean decades really, Verizon Wireless owned this award. It was their entire brand identity, the best network.
It was their whole thing.
But in this 2026 report, T-Mobile rated highest in 5 out of 6 regions in the U.S.
5 out of 6, that's not just a win, that's a landslide.
It is. And the report notes the historical significance of this. By winning those regions, T-Mobile broke a streak where a competitor, and the implication here is largely Verizon,
Right.
had led the category for 35 consecutive reports.
35 reports, that's years and years of dominance just snapped.
It is a changing of the guard. Imagine a sports team that hasn't lost a championship in a decade suddenly getting swept in the finals.
That's a great analogy.
That is what just happened in the wireless industry. And it's not just J.D. Power. They also cite Ookla and OpenSignal, which use technical testing apps on people's phones to measure speed. T-Mobile won Best Mobile Network from Ookla and swept all 5 overall network experience categories from OpenSignal.
So this isn't just a survey of happy customers. The technical probes and the speed tests are saying the same thing. The network is actually faster and more reliable.
Right. And if we connect this to the bigger picture, think about the strategic nightmare this creates for AT&T and Verizon.
How so?
For 10 years, T-Mobile's pitch was, "We're cheaper." Now their pitch is, "We're cheaper and we're better."
That's the widening differentiation they keep talking about. If I can get the best network and a lower price, there is zero rational reason to stay with the expensive carrier.
Exactly. They have neutralized the one weapon the incumbents had left, the perception of quality. They've taken away the premium argument.
However, and there's always a however in business. Let's move to Section 4, the fine print. Because you don't generate $71 billion in revenue without cracking a few eggs. I was reading through the expense lines and I saw something about workforce transformation that usually sets off my alarm bells.
Yes, this is the reality check. In Q4, their net income was $2.1 billion, which is a very strong number. But the report explicitly mentions it was negatively impacted by $293 million in severance and related costs.
$293 million in severance. That represents a lot of people losing their jobs.
It does. They label it a workforce transformation and reinvestment initiative. It's a stark reminder that even when a company is growing and succeeding, they are often ruthlessly efficient.
So they're cutting jobs somewhere to save money.
They're likely cutting roles in legacy departments, maybe customer support that's being automated by AI, or reducing their retail footprint to reinvest that money into engineering and digital systems.
It's the dark side of efficiency, I guess.
Yeah.
The Un-carrier is still a massive corporation that cuts costs. And speaking of corporate moves, they aren't just growing by selling phones, they're buying up other companies.
Aggressively. The customer numbers we celebrated earlier, they include customers acquired from UScellular, over 3 million of them. And they also mention acquiring fiber customers from Metronet and Lumos.
Wait, I wanted to ask about that. Why is a wireless company buying fiber optic internet companies? I thought the whole point was 5G home internet through the air.
That is a brilliant observation.
Yeah.
It shows that T-Mobile knows the limits of physics. Wireless internet is great for many people, but for, heavy users or dense urban areas, nothing beats a physical fiber wire into the house.
Right.
By buying Metronet and Lumos, T-Mobile is hedging its bets. They want to own the home internet connection, whether it comes through the air or through the ground.
That is a very mature, very establishment strategy. It's consolidation. They're becoming the bundle.
It is. They are realizing that to keep growing, they can't just be a phone company. They have to be a connectivity company, regardless of the technology.
So, looking into the crystal ball, they provided guidance for 2026. After such a massive year in 2025, are they expecting a hangover?
Does the party continue?
Yeah.
They are forecasting continued growth, but maybe at a slightly more mature pace. For 2026, they expect postpaid net account additions between 900,000 and 1.0 million.
Wait, 1 million? They just did 2.4 million customers in a single quarter. Why the big drop?
Careful with the metric there.
Mm-hmm.
The guidance is for accounts, not customers. One account, like a family plan, might have 4 lines on it, so 1 million accounts could still mean 3 or 4 million customers.
Okay, that makes more sense.
But even so, yes, the law of large numbers kicks in eventually, can't double in size forever. However, look at the profit guidance.
Okay, I'm looking here. Core adjusted EBITDA expected between 37.0 and $37.5 billion.
That's up significantly from the $34 billion they just did. So even if customer growth slows slightly, they're getting much better at squeezing profit out of the customers they have.
They're becoming a cash machine.
They are. And cash flow is expected to stay strong, around $18 billion to $18.7 billion. So steady, massive profitability.
And are they still innovating? Or just counting the money?
It seems like they are. Did you catch the note about the translation service?
Yes. That was buried in the intro, but it sounded really cool. Something about real-time translation on phone calls.
Announced the same morning. It's a network integrated service where you speak English and the person on the other end hears Spanish, or vice versa, in real time.
That feels like science fiction, like the universal translator in Star Trek.
It's the future of the network. It's not just about connecting call A to call B anymore. It's about using AI and computing power in the network to add value.
And that prevents churn.
How so?
Well, you think, I can't leave T-Mobile, I need the translator for my business calls with suppliers in Europe.
Precisely. It makes the service sticky.
So let's wrap this up and synthesize what we've learned. We started with the question, is all this industry-leading talk just marketing fluff?
And the answer is a definitive no. The data validates the claim. They have the most growth, they have the lowest churn, and now they have finally captured the crown for network quality.
It really feels like a completed journey. They started as the scrappy underdog, the uncarrier with the magenta t-shirts and the rebellious attitude. But looking at these financials, $71 billion in revenue, buying competitors, leading the industry, they aren't the underdog anymore.
They are the heavyweight champion, and that can be a very dangerous place to be.
Why is it dangerous?
Because when you're the underdog, you take risks. You fight for every customer because you have to. When you're the leader, the temptation is to get defensive. You protect your margins, you raise prices, you start acting like the very companies you used to mock.
You build a moat instead of building bridges.
Well said.
And I guess that's the big question for you listening to Chew On. T-Mobile spent the last decade fighting big telecom. Now that they're big telecom, what happens to that culture? Can you stay a rebel when you're returning $14 billion to shareholders and buying up fiber networks? Or do you inevitably become the establishment?
It is the paradox of winning. We'll have to watch closely in 2026 to see if they start to slow down or become complacent. But for now, the scoreboard says they are winning.
And that is where we will leave it for today. As always, if you want to geek out on the balance sheets, the severance packages, or the J.D. Power reports, we have linked the full sources in the show notes.
Thanks for listening.
We'll catch you on the next deep dive.